Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another Market Radar podcast. It's episode 23. It's August 7th. Apologies in advance. I'm sick, pretty mangled, so that's why my voice sounds like this. Let's take a look at the calendar. So we've got a pretty big week coming up. Monday, we've got no market moving events. Tuesday, we've got productivity and costs. Wednesday is the big day. We've got CPI and EIA petroleum status report and the Treasury statement. We also have Charles Evans speaking. And Thursday, we've got jobless claims, another big day, PPI final demand, EIA natural gas report, and the Fed balance sheet. Friday, we've got import and export prices and consumer sentiment. Let's take a look at the year-to-date performances. Year-to-date, everything is still bearish trend. S&P down 12.95%, NASDAQ down 19.13%, Russell down 14.23%, and the Dow down 9.73%. We've got a total risk-off chance of 66%. It's slowly been going down, and we're seeing inflation odds creeping up. So wouldn't that be a kicker if we get a fat risk-on regime right when everyone thinks the world's going to end? We'll see.
Yeah, that would be completely unexpected. And again, we're gonna follow the market. If that happens, we're gonna pivot. But if it doesn't, we're gonna stick with our guns. So it's all a matter of what the market's telling us. Right now, recession is prominently being priced in by the market in general, given that 66%. North of 60% of the probability of a risk off is where we are today. But if anything does change, we'll take action immediately. And we want to make sure that we're with the market and we leave our opinions at the door.
Yeah.
Yeah.
Something else to note, the strength of stagflation right now came down quite a bit as well. If you scroll down to the strength chart.
Oh, yes.
Yeah, right here. So you can see the strength of this stagflationary regime did pull back quite a bit.
Yep. And this is primarily due to the rally in risk assets, because what we're seeing right now, while it is predominantly a stagflationary rally, the more risk assets rally and the more the market picks up a risk on strength signal, the lower the strength of the current risk off regime is going to be. It's just how that works. And if we do see a reversal in the market heading back towards lows or a breakdown in risk assets, it's pretty likely then the system strength will pick back up and shift higher as we stay in a risk-off regime. So with that said, I think we should go right into ES and talk about what happened this week.
Yeah, so pretty big week. Actually, kind of flat, but
kind of flat, but more big announcements. But we'll get into that later.
Yeah, we're seeing ES slowly chugging along. We could still see Momo, still easily see a push up to Momo. That would be, I believe, max pain, but that's just my opinion.
Do you remember when we said that down here? We were like, yeah, move to Momo. Like you have to be okay with your positioning to handle that.
Yeah.
And sure enough, here we go.
Yep.
Literally.
This is why leverage is not to be used right now. Yep. Because, if you're leveraged short, that's essentially what's fueling this rally.
Right. And there's a difference between holding leverage shorts, by the way, and actually like outright your portfolio is leveraged itself short. We have leverage short securities in our portfolio, but our portfolio is over 50% cash. So we use smaller denominations to lift up the short size, but our portfolio itself is not actually leveraged in its entirety. That's what's important. So leveraging your portfolio in entirety in a risk-off regime is not something that I would say is a good idea.
Well, unless if it's deflation and we're going balls deep in TMF.
Oh, that's different.
Yeah,
That,
that's
that's different.
different.
I was talking about risk assets, but yeah,
Yeah,
yeah. In the case of bonds, yeah, that's a different story. That we're
that's
in there
that's
with
the
our
risk
swimwear.
off that you want to be going
Yeah,
with risk.
exactly. So let's go to ZN because that actually pulled back quite a bit since
Yeah,
our last podcast.
since our last podcast, what was it called? It was called "If You Buy
Uh,
Bonds, You Will Lose Money."
yeah. So
Well,
far, I mean, so far
that's what
it's.
happens. You know,
I mean,
you don't
go ahead.
see. Well, I mean, like this could definitely still continue, but if it was really the bond play with conviction, you don't really see big gapings.
Yeah, that's true. That's actually quite true. And also given that um, momentum usually picks up to the upside much more aggressively when the bond trade arises, you start to see these mega rips, right? These mega rips that are have shallow dips and they continue to rip. That's because everyone's chasing bonds. It's like the bait fish when you're fishing. Like you see the bait fish jumping out of the water, it's because they're being chased by bigger game. Literally, what's going on here in bonds is they've done absolutely nothing for months now. Now, I'm sure, yeah, you can make the statement you collected a dividend, or if you're owning the ETFs, you're collecting a dividend. If you own actual bonds, you're collecting coupon payments. But what's the whole point of us um, following the system and basically designing the system in this fashion is not to collect coupon payments of 1 to 2% a year. Well, right now they're closer to 3, but you get the point. We're looking to take concentrated positions with conviction and capture much bigger returns than the average person will in a 60/40 or just holding SPY by itself. As you can see, ZN has been pretty much shit ever since 2020. Things fell off a cliff. And there's no reason for this, I guess to say this the right way, there's no reason for this not to keep falling, not to keep shitting the bed. The reason for this not to keep shitting the bed would be it going bullish trend. And we'll speak more about how this is being portrayed with the bond market as a whole later in the podcast. But let's um, let's go from here and let's talk about the important events that happened in this last week. So last week we had the S&P Composite PMI as of July came in at 47.7, which was 20 basis points over estimates. But as expected, this was a decline from the prior figure. So remember, typically a reading above 50 indicates expansion and below 50 indicates a contraction. So the reading was 47.7, indicating that there is currently an economic contraction. Now, the composite PMI is a 60/40 split between the manufacturing and service PMI. So there's two PMIs under composite, right? Composite, so it's compiled of two of it's not it has multiple components, and the composite PMI has two components, that being manufacturing PMI and services PMI. Manufacturing has a 60% weighting and services have a 40. So we had manufacturing PMI come in at 52.2, which is 10 basis points under estimates. But as expected, this was a decline from the prior figure. As you can see, manufacturing is currently not yet in contraction, whereas we had the S&P Services PMI as of July come in at 47.3, which is 30 basis points over estimates. But as expected, this was a decline from the prior figure as well. So what this was showing us is manufacturing is still not in a contraction, where services, however, is in a contraction. And then we had ISM manufacturing PMI. Now I just told you we had S&P PMI. This is ISM PMI, and this was as of July. It came in at 52.8, which was 20 basis points under estimates. As expected, this was a decline from the prior figure. Now the difference between ISM manufacturing PMI and the prior S&P manufacturing PMI that I just mentioned is that the ISM focuses on sample sizes of larger multinational companies, while the S&P surveys a mix of company sizes. We then had the JOLTS jobs openings as of July come in at 10.69 million, which was 302,000 under estimates. But as expected, this was a decline from the prior figure. Despite the drop, the number of vacancies remained elevated as the demand for workers broadly outweighs supply. meaning the job market is still tight. We also had factory orders month over month last week, and that was as of June, which came in up 2%, which is 90 basis points over estimates. And this also beat with an increase from the prior reading where a decline was expected. So factory orders came in stronger than the prior reading. And instead of a decline, we did post a gain there. And then we had the ISM non manufacturing employment as of July came in at 49.1, which is 1.7 points higher than the prior reading. So we had an acceleration there as well. And then we had ISM non manufacturing PMI as of July come in at 56.7, which was 3.2 points over estimates. This also beat estimates with an increase from the prior reading where a decline was expected. A big beat here overall as well. And then we had the trade balances as of June come in with a deficit of 79.6 billion, which was $500 million over estimates. But as expected, this was a decline from the prior figure. Now, for those that don't know, a trade balance is the difference between a country's imports and a country's exports. So typically, a rising trade balance is seen as a signal of an economic slowdown, as or the country itself is consuming less, which is typically bullish for their currency. So in this case, the slower consumption is bullish for the dollar, which is what's giving the dollar a bid. Now, the deficit did hit an all-time low just a couple of months ago. I believe it was in April, and it has printed higher basically every month since then. So the deficit is on the mend right now, and those that want the dollar to break down, we're going to need to see a pickup in consumption. Now, we spent a lot of time in a deficit range of 40 to 60 billion. I believe it was between like 2012 and 2010. So where we are right now, 2012 and 2020. So where we are right now, I mean, we're at 79.6. So we're still above the medium term average of a deficit, meaning we're in a deeper, we're in a much deeper deficit than normal. So we also had non-farm payrolls as of July come in at 528,000. This was a big beat because it was 278,000 over estimates. And it came in higher than the prior reading where a decline was expected. So we were expecting to see a decline in payrolls. Instead, we basically came in and doubled payrolls to the upside. So this was one of the biggest surprises in the past week, and it signals, again, the labor market is not yet affected by the Fed's actions. And we know there's a lag with what the Fed does, right? We know that the Federal Reserve's the Federal Reserve's actions taken today will lag out and appear in the economy within, 3 to 6 months. So, and we also know that the labor market is tight until it's not, right? So the labor market is going all good and swell until unemployment picks up, and it usually picks up at a much faster rate than it does go down. So when it accelerates, it tends to do so rather quickly. We also saw the participation rate as of July come in at 62.1%, which is 10 basis points under the prior reading. And then we had the unemployment rate. This was another big reading on Friday, which sent the Federal Reserve, the effective federal funds rate higher, or the terminal of the it sent the terminal of the EFFR curve higher because we had the unemployment rate come in for July at 3.5%. And this was 10 basis points under estimates. Estimates had this matching the prior reading, but we actually saw this come lower than the prior reading. And this is now at a multi-decade low. As we spoke about this last week, the way the Fed operates is, and they basically base their mandates and policy structure is around this number, the unemployment rate and inflation. Remember, while we had someone in the group this week that basically illuminated how the Phillips curve is an inefficient curve, meaning it is not realistic. And to a certain degree, yes, but we have to look at it from the way that the curve is interpreted. The central bank uses the Phillips curve or relies on it and sees it as a valuable tool or a way, not a valuable tool. It's their entire fundamental basis. Their main two mandates are maximum unemployment and price stability. So that is literally the Phillips curve. So they are going to operate within the realm of the Phillips curve in terms of how they enact monetary policy. So if we see unemployment rate sticking very low while inflation is very high, they are going to think that they can continuously hike, because in reality the Federal Reserve is their main mandate is to watch employment. So if they don't see employment breaking, they are, in their minds, they're not doing enough. Now, we know that the Federal Reserve at some point will over crank the wheel, as they always do, and then it'll come back to bite us. But that's how this works, is a lag. And the way that the central banks are operating is they're running forward with lagging data, and the way that they run forward lags beyond the way. Okay, so think of it like this: they are. I want to simplify this. They're looking at data from the past and acting policies today that won't work until the future. So there's a bunch of lags in either direction that's going on here, and that is the problem with how this whole monetary system is set up. But obviously, given how low we just saw unemployment, we don't see a Fed pivot appearing just yet. Now, we actually saw the terminal rate push almost 20 basis points higher on Friday and further out on the curve, signaling that there are actually more rate hikes than expected or than priced in earlier in the week to come. So, what I want to go over today, and what I want this discussion to be about, is primarily real yields and then the yield curve. I think those are the two most important things, given what we just saw with the unemployment numbers and CPI in the coming week. We should cover this now, because these are going to be hot topics in the next week or two. So we're going to start with the real yields. Right now, they're actually recovering quite well after the dip. They dipped down here in July. We came off the highs of 75 to 80 basis points, and this is the 10-year real yield. So we came off the highs here.
That's actually a deflationary sign, isn't it?
Right. Yeah, it's a deflationary sign off the rip, but we're actually recovering quite nicely here.
Mm-hmm.
The real deflationary sign is when they start chasing real yields into negative territory. That's like where like things really get scary, because why someone would accept a negative real yield and then continuously bid after that is the assumption that yield rates are just going to go lower, right?
Yep.
And we are not in negative territory yet, which kind of keeps the environment that we're in alive, because obviously once rates start falling and deflation does hit, which we expect that to be the highest probable upcoming regime, is going to be deflation. We are right now. This is our reasoning. Obviously, stagflation is peak cycle, which then we rotate to deflation, and from there, growth and CPI are both falling simultaneously. Where right now we only have growth falling, CPI is actually still rising. This is what most consider the bust of the economic cycle, where then we come back into the expansion, which is like the recovery. Then we go into peak late stage, and then back to the bust. That's how the economic cycle works. So we are now in late stage, and odds are we head to deflation. Now we could skip deflation if GDP wants to really accelerate, and we can actually go back to inflation if CPI continues to rise and GDP just picks up. Now, that's what our system has been slowly picking up here. As you see, the odds of a inflationary regime have continuously ticked higher, and we are getting close to actually we're only, what is that, 5 basis points, or no, excuse me. Yeah, no, 5 basis points away. No, I'm sorry, 5%. I apologize. We're 5% away from inflation matching deflation at the moment.
Which is very odd.
Very odd.
That's not something we see often.
Right, but that's something we have to pay attention to, because it could be signaling that indeed we could be going back to a risk-on regime. Now, that's not saying, recession's bullshit. Obviously, the market's pricing in a recession, which is why we harp so aggressively on it. We still stand in the recessionary camp because the market still says so. But everything changes when the market pricing changes. All of our opinions right now are based around. So the opinions that you see coming out of us are all supporting a recession because the market is supporting a recession. So what's going to happen if the market starts to support a recovery or basically a risk on regime? Well, you're going to start seeing the verbiage from us, like that comes out of us, to be more geared towards an economic recovery. We're going to harp on all the positive things of the economy because the market's supporting that. We harp on all the negative things at the moment because there is more negative things at the moment than there is positive. But the reason we harp on these negative things is because the negative things support what the market is saying. We are always going to go with the market. The market is the king. It's the government. It's the top dog. So if the market says something, we're in a recession or we're in risk on, risk off, I should say. Well, if the market says we're in risk on, we're going to find all the data points that match a risk on regime, and we're going to talk about those data points. Now, typically, when the market is in a risk on regime, there are going to be more risk on data points. As when we are in a risk off regime, there are going to be more risk off data points. There is always going to be a risk on and risk off data point in either regime. There are risk on data points right now that have come out, yet we don't hold much weight to them because the significance of where that we are in the cycle, they are irrelevant. The market itself is not in a place that a risk on data point itself means anything. Remember, when the market is risk on, every risk on data point is cumulatively adding to the overall strength of the market. But when the market is risk off, a risk on data point is the odd lot out, so we don't pay much attention to it. And that's what the importance is behind looking at what the market is and how the market operates, because the market knows all of these data points already. We are seeing these data points in real time, right? Let's just say we have a great employment report, right? The great employment report that we just saw, that's a risk on data point. The labor market's still tight, right? But we see GDP, on the other hand, weighing lower, coming in under estimates, coming in negative for 2 consecutive quarters. Now, we're in a risk-off regime, so the unemployment is not going to be weighed as much as the GDP. While, frankly, GDP is weighed more in general, but you understand the point here. The point is that we are taking the data points that we see and going against the regime the market's basically pricing in, and we are going to look at the data points that correspond accordingly. Now, when the market regimes flip, you will also see the data points flip as well. More data points more risk on data points will appear, and so on and so forth. So I think that's important that we talk about this because as inflation picks up, we have not seen an overall shift in the data in economic data that's coming out because it's been pretty much recessionary. So until this takes over, there's no reason for us to even start thinking about a shift in the regimes because most likely the next probable regime under stagflation is deflation. So until something here changes, we will stick to the strong risk-off regime that we have been experiencing for over a year now.
Well, this just emphasizes the importance of looking at all corners of the market.
Right.
Because you can easily pick and choose, oh, this is a risk on data point. So
Yep.
exactly. and a lot of these macro tourists are only looking at some data points and they're falling into the deflationary trap. And that's why they're longing bonds. And
that's a good point.
You got to really look at the full picture if you want to avoid those kind of traps, because they do happen often. The market isn't going to be straightforward every time. This is actually a very confusing environment right now, and a lot of people are not playing it right, and they're falling for all the traps.
Yeah, normally, believe it or not, bonds are a great play in stagflation. They really are, because we know that deflation is normally a following event from stagflation. So getting into bonds when stagflation hits, stagflation is usually rather short. It's like the opening, it's like the crack of the window. You can just squeeze through, and then deflation comes through. So like when you see stagflation, you're going to get yourself geared up for bonds. The problem is we've gotten this stagflation trigger, and bonds have remained bearish trend. So there is no signal for us to get interested in bonds at the moment. Now, let's go back to the yield curve quickly, because obviously the yield curve is holding. I mean, not the yield curve, the real yields. I apologize. So let's go back to the real yields here. The real yields are holding up quite well, given the fact that we are still in a stagflationary regime. Now, once we get to a deflationary regime, we will see real yields fall. This is what happens because people are chasing bond yields as the base. What they're doing is let's take a look at break evens because you'll understand why real yields can easily go negative in deflation. So this was the orange line you see, the red line you see here. This was the last Powell pivot in 2018, where basically the Fed stopped hiking and they reversed course, and since then, real yields took a dive all the way down. What happens when there's deflation? If we look out on a larger time frame, the break-even rate tends to, going back to 2003, tends to sit realistically between 1.25 to 2.4, right? 2.5. That's where it sits in. Now, the 10-year Treasury, on the other hand, can move much more, or can move outside of those bounds much easier, meaning when people expect a recession, everyone's chasing bonds, and it can push down the nominals to a point where it's very easy to invert real yields, because all that has to happen is the 10-year has to go under 2.46, and real yields are essentially negative. Not to say that we're going to see the same type of negative effect we've seen here, because this was drastically negative, but it's very easy for real yields to go to zero and basically sit around zero for a long time. Or chop between, be very low. Now, the last time we saw the Fed pivot was in 2018. Real yields were at 1%. Right now, we're at 37 basis points. So the pivot's not here yet, and we are only at 37 basis points. So our reasoning here is on why we think that real yields can go higher. It's basically due to the fact that what the market's pricing in today is a 367 basis point terminal, which is why you're seeing this bounce, by the way. This was up 18 basis points. This is up almost 100. Real yields rose almost 100% on the 10-year time frame post the employment report on Friday, because it's showing you that the terminals have to go up. The more the terminals go up, the more real yields are going to go up. So let me put it to you like this. If you think the Fed has pivoted, buy bonds today, because real yields will go lower, right? Or real yields have peaked pretty much. Now, if rates are expected to peak in the next 8 months, then what you're going to see is the demand for longer term treasuries keeping these real yields at bay. That's why you would buy those bonds, right? But the problem is if the terminal keeps grinding higher, those who are chasing yields today will realize that they're really early. So a good way to think about this is let's look at the 10-year yield, and let's make this white. So this is the 10-year nominal yield. We basically peaked where we did back where Powell pivoted last time, which was in 2018 around 3.25, around 300 basis points. Now, the terminal rate for the Fed as of Friday was 367 basis points. So it's already higher than where we're trading on the 10-year right now. And this has to do with the yield curve, but we'll get into that in a few minutes. So why is this trading under the terminal rate? If the Fed's expected to get to 367 basis points, why are 10 years trading at 283 right now, right? That is due because the Fed is going to get there within the next 7 to 8 months, but then following that, they're going to have to hold policy and then cut. They're not going to stay there for 10 years, right? That's why there's a discount here because the bond market knows the Fed's going to have to cut at some point. The problem is the spread between the terminal right now is 367. So if we do, 367 minus 283, it's 84 basis points, right? If the terminals continue to grind higher, what's going to happen is rates themselves will also grind higher. And the problem we're going to run into if that happens, if terminals really start picking up and we get like above 450 basis points and so on and so forth, we start grinding higher. And the key is not grinding higher as much as it is grinding higher and grinding longer. Meaning what we saw on Friday was not so much a 20 basis point move higher on the terminal rate. It was a 20 basis point move higher on the terminal rate and out an extra meeting now. So now they expect the terminal rate to be lagged out to another meeting, meaning rates are going to have to stay higher longer. Now the problem is if rates stay higher longer, they take up more time of that 10-year time frame, right? Because if rates are only higher for the next 6 months, right? That's what 1/20th of a 10-year yield. Now, if rates stay higher for the next 2 years, you're now 1/5. So this is the problem with the terminal rate grinding higher and going longer. If the terminal rate grinds higher and goes longer, we're likely going to see rates exceed the prior peak here in June. And that's going to be very detrimental to those that have chased bonds today if that happens. Because everyone who's chased bonds today thinks rates have peaked, right? If you own, let's turn this into
Well,
a 10-year.
is there a way to calculate at what terminal rate? So let's say terminal rate is 450 basis points.
Right.
Is there a way to calculate what the break evens are going to be?
I'm sure there's a model out there that you can run, maybe on the terminal, but not so much because remember what matters more is the time at which the terminal is in existence for, right? So if that 450 basis points is there for 2 years or it's there for 3 months,
Mm-hmm. Yeah,
it's going to push the break evens in different directions, right?
I see. Okay.
So we have to pay attention to the timing. And if we overlay, let's overlay TLT onto this just to get just to basically make a point here and make this white. So everyone here knows that bonds are off the lows, right? Bonds, oh my God, bonds are off. TLT was at 112, now it's at 116. Oh, we got the Fed pivot, yeah, blah, 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 blah. You know, the whole gargle of bullshit that you're hearing from FinTwit. That it's time, the bonds are the play. Let me explain something to you. If the 10-year goes back to the prior high, that means TLT will likely break its low. Everyone that is sitting right now in confidence or basically in false conviction, because there's no reason from a trend perspective, both bonds are bearish trend and rates are still bullish trend. So there is no reason to define what you're seeing now as an actual trend shift. Really, it's just a counter trend move. But those that are taking this opportunity to put positions on aggressively are not seeing it that way. They're seeing it as the Fed pivot. How much more could the Fed actually hike, even if they go up? Their thinking is this, which this is the powerful part about looking at the market. You can basically dissect different viewpoints because at the end of the day, the market is going to be right more times than your opinions will be. If people's opinions were right all the time, you would have no one. Basically, there would be no reason for a hedge fund, right? If their opinions were always right, because they can compound money way faster than borrowing it. So when you look at the market like this and you say, listen, bonds can still go higher, rates can still go lower. Sure. Could they break trend? Sure. Odds are not favoring that until the trends have reversed. So those people that have allocated capital to either being outright short interest rates or long bonds, which they're the same thing, if bonds go lower, or I should say rates go higher and take out the highs and bonds go lower, everyone that has put a trade on in the last 3 or 4 months that has expected the bottom of bonds to be in is now wrong, right? So everyone that is currently thinking they're right is now proved to be wrong. So what happens? Well, if people start realizing that the terminal can shift a lot higher than just 20 basis points, because that's what we saw on Friday. We saw the terminal shift 20 basis points up. But if people believe that, oh shit, maybe like terminals can go another 100 basis points higher than where they are right now, or just, God forbid they go, you know, we get all the way up to 600 basis points on the terminals, which again, we're going to let the market take it from wherever it wants to go. But we're just telling you that marginally, the more that gets priced in the terminals, the more wrong these bond buyers become.
Well, yeah,
So
we saw like a 2% down move on ZN just from a 20 basis point terminal move.
right.
So
Right.
imagine 100 basis points.
Yeah, just think about that, right? And also imagine about what happens to those people that end up figuring out, because listen, most people are going to buy bonds right now and they're going to say, this is the thinking, right? And it's very logical. Let's break it down. I want to own TLT, right? I'm going to buy TLT, and let's pull up TLT itself here just so we can see. We'll put on a bar chart. We'll actually take off DDAP so it's nice and clean. So now you're like, okay, TLT's back down to the 2015. Look, it's been a lot of time here. Odds are, TLT will go higher over time because rates, if we look at the EFFR real quick, odds are over time This actually has to go higher, 367. It's funny how we keep moving this line up every time we record this
Yeah.
podcast, right? But anyways, over time, the federal funds rate always crashes, right? It's typically going to crash at some point. So that's why if you're basically long bonds, it is or if you're looking at bonds, it's lucrative to say, oh, well, the the federal funds rate will get cut at some point, so bonds will be a buy again, right? The problem is at what point do they get cut? Do they get cut at 367 basis points, or do they get cut at 600 basis points?
Yeah. And well,
Right?
it's the trap here is the whole 60/40 portfolio. If
Oh, yeah, that's a double gong in itself. But yeah,
yeah,
go ahead.
yeah, well, but that's just like the common thing that you
Yeah.
do. When a recession hits, you get deflation and bonds are the play. But we're in a different situation right now. This is an inflationary recession, and that's where people are getting caught.
Right. That's another thing I've it's the funniest thing. Um, I've spoken to people, I've seen people on Twitter. I've had meetings with people where they go, "Oh, the economy's while the GDP is slowing, like it's just a technical recession." And this has been basically put into people's heads by the government. Unfortunately, the government is getting involved in lately we've had this trend where for some reason we like to redefine things. I don't know why. No hate on it. You want to redefine a word, but at the end of the day, it's obviously apparent. It's apparent that we are in a recession. People don't understand that there is a thing called an inflationary recession. It is a recession where both sides of the table get smoked. It's not common. As you remember me saying earlier, stagflation is usually short. Stagflation is literally, out of the four regimes we track, it is the shittiest regime. It is the worst regime that you can get. It is the most uncomfortable, the most annoying. You sit there, you're like, why don't I have any positions on that are really performing? Why is the market doing this? And unfortunately, it's the longest one we've seen in over a decade, or actually almost 20 years. So, why is it that people get this confused? It comes back to the thinking of the 60/40 portfolio, exactly what you said earlier. People see risk on, oh, my stocks are going to do well. People see risk off, okay, no big deal. My bonds are going to do well. I have a portfolio that gets the boom and the bust of the economy. I'm hedged. You are for 75% of the regimes.
Yeah,
There's a
most of the time that
Yeah,
does
most
work.
of the time it does work, right? Let's look back. We have it actually overlaid here on our website. As you can see, look at 2008, right? In 2008, stocks take the shitter, bonds go up, you're hedged. Easy, right? In here in 2011, stocks take the shitter, bonds go up, you're hedged. Now that we're both hitting the shitter. Well, why? And this is because the 60/40, for those that don't know, is not stagflationary proof. It's not. Reason is simply when inflation is accelerating and you have lower growth. Think of it like this: lower growth usually comes with lower inflation, right? If we go to our curve here, both decline. When you have only one of these declining while the other one is rising, you're taking half the equation. Lower growth and lower inflation and deflation means lower inflation bonds go up, lower growth stocks go down. Well, when you have lower growth and higher inflation, well, in higher inflation, bonds go down, right? So you still have that effect of bonds going down. But now you have the effect of equities going down too. This is why the 60/40 does not work in stagflation. And a lot of people, unfortunately, a lot of elderly people have gotten caught off guard because their money managers do this 60/40 thing. For those that don't know, in the money management world, you basically have a risk profile you basically get assigned or sign up for when you open an account. You assign yourself to a risk profile. If it's moderate, speculation, conservative, whatever that is, in the asset management world, you basically are assigned to that management level. Now, no matter what happens, you have legally or fiduciarily, the advisor has to stick within those boundaries. Meaning, if you're a conservative investor, he has to own a certain number of bonds and cash in your account, no matter what. Now, he can own more cash than bonds, but he also can't go too low on the spectrum. he can't just put you in all cash. Technically, I'm sure some people have done it, but technically he's supposed to keep you in that risk range. So if you're coded for extreme speculation, your accounts are getting smoked right now, or their accounts, I should say. If they're a speculator, I'm assuming those listening um, are trying to do it a better way and manage their own, be the fate of their own future, where you're not letting someone else control it. But I'm sure some of you guys listening or someone that has money with a money manager, and you should see how they're performing year to date. Odds are that their hedges are getting smoked and their growth plays are getting smoked. The reason is because no one knows how to play in stagflation because stagflation is not common. Um,
Yeah,
and
last time this happened was the 80s.
yeah,
We
and
haven't seen this since the 80s.
And literally in the 80s, the only difference in the 80s were that real yields actually plunged at some point, which gold had a bid in that environment. Gold caught the bid because real yields were going extremely negative, right? In 19 we can pull it up right here quickly. So let's go to inflation rate year over year. And let's look at the let's see, US 10 year. Let's see if we can look at the 10-year. You know what? Let's do the 2-year. Okay. Oh, sorry. Gotta pull up the. We'll add the inflation rate on top of this. Spelled that wrong. Okay. So back in this only goes back to 89, so we're gonna have to try and just do 10 years, see if we can get further back in time. 80. Okay. And let's do inflation over white. Okay. So at one point we had basically inflation fell off a cliff here, right? And the 10-year held a bid for a lot longer.
So why is
So,
that?
well, what ended up happening was real yields blew negative. And the reason the 10-year yield held up so much is because of you had a lot of people. What we're seeing right now, where a lot of people are thinking they're right, and you do this, you do enough of good. You put the 10-year at 13%. You basically have people losing confidence. Like, you don't, like, are we going to 20%? Like,
Okay.
what's the point? What's the point to bid yields, right? Then we had inflation fall apart, and then after that we had the lag where the 10-year yield did come down. But in this process, the break evens were falling, right? Real yields prior to this move, as you see, inflation was above. It took basically yields to climb above the inflation rate to break it. And we went over this a couple of videos prior to this one. We were talking about, I think it was the 30-year, right? That's the one that we like to use. 30-year likes to, and let's pin this to a different pin to scale A. So normally the 30-year spends more time above the rate of inflation. Look at the difference now.
Mm-hmm. Yeah,
right?
They flipped now.
Flipped hard. This is not like ever since 88, the 30-year was above the rate of inflation for a reason. Now we're flipping hard. So either something's going to break here. Either 30 years going way up or inflation is going to go way, 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 way down, right? But what happened earlier with the real yields is the break-evens were accelerating faster than the nominals. It took a while for people, because what ends up happening when the nominals go higher, people keep thinking like what they're doing right now, oh, peak, we're going to buy, right? And they slow it down, where the break-evens are going to move much more efficiently, because you're going to buy, the way the break-evens are basically being shifted are through tips, right? So you're buying tips, right? If you think that there is going to be a big bust in rates, you're going to make more money in nominals than buying tips. So the incentive to chase nominals is there, right?
Mm-hmm.
So what ends up happening is you have people chasing nominals getting burnt in basically a capitulatory effect, where you have a lag in real yields. Now, what we saw in the 70s stagflationary era was real yields go deeply negative, right? And that pushed gold way up, okay? And that got people thinking, oh, inflation is going up. Really, what was going on was break-evens were were just outpacing the rate of treasuries, because break evens were rising at a faster rate than treasuries, because people were trying to play with bond yields and people getting smoked. Tips were gradually, or I should say, break evens were gradually ripping, right? Which
So that's where the misconception comes from, that gold is
right.
an inflation hedge.
Right, and if you think about it like this, because obviously, let's look at the break evens. We can't go back. Let's clean this up a little bit. We can't go back that far with break evens. We can only go back to like 2003. Tips only were invented in like 1997, I believe. So, to understand this, what we have to do is we have to chart real yields, which we do as follows, and we have to overlay gold on top of it, right? Let's understand this. And this is how we know. So a lot of people have trouble understanding how real yields could have gone negative in the 70s, right? Because there is no break even in the 70s. That's the problem. Is a lot of old school thought to calculate or I don't know if it's more FinTwit, the way that they think. To calculate break evens, you have to take the rate of inflation, okay, and or the nominal yield, excuse me, and subtract the rate of inflation from it. So the nominal on a 10-year right now is 2.83. So if we take 9.1 minus 2.83, real yields will be extremely negative. Well, this is the reason tips are so important, or break evens, because break evens account for the rate of inflation over the entire term of the bond, where CPI is year over year, and it's really mean reverting if you think about it, because as prices stay higher or longer, the rate of inflation, or even if they go sideways, the rate of inflation can actually drop significantly, right? So, and that's basically due to base effects. But long story short, keep it simple. Inflation is only, while the price inflation is permanent, price doesn't really deflate. The rate of change itself is temporary, and it does fade away and before picking back up again. So what ends up happening here is, if we look at real yields, which is the 10-year minus the 10-year break even, you can see it's almost an inverse. Let's invert the real yields. We've gone over this in so much depth on our Twitter. This is they're basically gold. If you take inverted real yields and you look at it against gold, it's the same thing. Now, if we want to do it one step further, let's add TLT. Same thing, right? They rip, they dip, rather in synchronous. Okay.
We tried warning people,
I
all the
know.
gold bugs,
I know.
like months ago. We tried warning them, but
We have a
they're
timestamp tweet, by the way.
gold bugs
We
are
told
very
people.
stubborn.
I know, we have a timestamp tweet, by the way. We told people to basically stay away from gold when it was ripping up to 2000. We said, yeah, listen, this is not what you think it is, and sure enough, here we are now.
Yep.
And it's simply due because real yields are rising. Real yields, meaning that there's better opportunity, there's tighter financial conditions, and there's better opportunity elsewhere outside of bonds. As real yields rise, bonds become more and more attractive the higher they go. So people start waiting to purchase bonds, and they start waiting to purchase gold. Bonds and gold are pretty much the same thing. They work in tandem. They move in tandem, right? It's basically an artificial diversification method. I own bonds and I own gold. Well, you really own the same thing. You're short real yields. That's all it is, right? It's a false method of diversification. It's like saying you're diversified, but you own one share of every S&P 500 company. Are you really diversified? You just own the S&P 500.
Yeah, like
Right?
everything's gonna fall together when it's risk off.
Right. So what ends up happening here is we can take a look, and actually gold does track real yields much better than treasuries, just given the fact that gold is less. This is also not accounting for dividends paid on the treasury. So you have to shift this curve higher if you basically account for dividends. But normally gold does track real yields a little bit more efficiently. And the reason we got so startled earlier this year is when we saw real yields shit the bed, and gold was actually going sideways, going up. And we said, well, we know the Fed's going to basically push real yields higher, just as they're going to invert the yield curve. And we're going to speak about that shortly in a few minutes. But long story short, let's take off TLT and let's look at just this. We know now that typically bonds will track gold will track real yields rather efficiently. So let's overlay let's overlay the inflation now, going back in time. We're going to go inflation rate year over year, and we are going to overlay gold. So GC, let's see. So as you can see here in the 19, let's see, let's put this in white. Okay. So here in inflation rate year over year. Oh, this is inverted. So let's revert this. Makes sense. Okay. So as you can see here in 1978, inflation started tearing again and going all the way up to the 1980s peak of 14.8. Bonds themselves ripped as well. But why? We know bonds' best performing environment is when in deflation when real yields are dropping. So what we had in here was a very unique environment where inflation was accelerating, but real yields were actually going negative.
So it was like inflationary and deflationary at the same time.
Yeah, pretty much. I mean, when you basically had people not like think about it like this. You're getting a 14.8% yield from a government from I mean, well, let's actually put on a 10-year yield here and let's see what this looks like. You were getting much higher. See, this is what I was talking about. The 10-year yield was way above the rate of inflation then. The 10-year yield went all the way up to up to 15, what's it?
So you were able to
15%.
beat inflation with bonds.
Well, let's pin this. Hold on. Again, this trading view thing is on the right. Okay. See? The 10-year actually overtook the rate of inflation from where we can track it. The 10-year was above the 1980s inflation peak at one point. But prior to, it took a long time to really rip up and go higher. And I think I can find a better we'll have to post a chart on Twitter later accompanying this with a Bloomberg chart, so this way you guys can see it.
Let's talk about the yield curve though.
Yeah, let's cover that. Yeah. So long story short, the yield curve is inverting on the in the front end rather decently now. We got the 2 years trading 30 basis points above a 30-year, which makes no sense, right? Lend your money out for 2 years, get paid more than you do for 30 years. Well, that's because the Federal Reserve is seen to have to continue to hike. Now, if we look at the very famous 2s and 10s curve, which is the 2-year curve against the 10-year curve, we can see that there is actually quite a bit of inversion there. Now, the traditional yield curve inversion has not happened yet, meaning the 3-month yield has not overtaken the 30-year yield. That's really what's considered a full inversion, where the front end is greater than the back end of the curve. So until that happens, people are like, oh, the yield curve's not really inverted, or inversions don't mean anything, yada, yada, yada. And even the 3-month 10-year, if we look at that, that's still not inverted. And that's primarily we know that's because of the Fed. We can only price in so many meetings in the next 3 months, so many rate hikes in the next 3 months, where terminals are expected to go higher even after those bonds mature. So let's take a look at the 2s and 10s. And the reason we look at the 2s and 10s is because 2-year encompasses most of the upfront Fed policy. It's also where the Fed holds a lot of control, anywhere from 2 years and under. Whereas the 10-year is more mean reverting, allows for a lot of other factors to play a role in bond pricing. So we are now inverting almost negative 50 basis points. This is on the verge of breaking the lowest point since 1989. We're currently under the 89 level, but we still are just holding above the 2000 level. And for those that say no recession, this is literally one of the best recession predictors that does exist.
I mean, look at 2007, we had an invert. 2000 invert. 2019 was actually a deflationary period on our model.
Yeah. So
it's pretty damn accurate.
This is not looking too hot for the risk on guys. Um, Now, can this change? Can this be a fluke? I mean, it would be great. This would be the first fluke in how many? Well, not the first, but this would be the one of few flukes that has pretty much ever been recorded with the yield curve. The twos and tens, people say, oh, the tens and threes, the 3 month and 10 years more accurate. Yeah, sure. But obviously, oh, excuse me, not this one. I'm pulling up the wrong chart here. The 10-year 3 month is right. Oh, I have it on the other. We'll just. Here. They say this is much more accurate, right? In timing and everything. But the reason that this can't invert is because of the fact that we currently have the Federal Reserve weighing down half of this curve, I mean, right? Or the spread, I'm sorry. Half the spread is being weighed down by the Fed. They have to hike rates. The 3 month is not encompassing all those rate hikes, which is why we look at the 2 year. The 2 year is pricing this in, right? The 2 year goes out. Let's look at the curve here. The 2 year gets all this in, gets the whole picture. Where the 3 month only gets the next 1 to 2 meetings, and that's the importance of understanding why the yield curve is inverting in the fashion that it is, especially in the way that it is not. It's not what most people consider an actual inversion. And to really understand this, you have to focus on the spreads. And obviously, that the spreads are telling us that something is obviously not right, and it's likely a recession is coming. And the importance of all of this is integrating it to the system, right? So our system is, like I said earlier, the backbone of what we talk about. The system is telling us that we're in a period of risk off right now. Right, so the system is telling us that it is a risk. We're on the forefront of a risk off economic cycle, and given that, right, we have to take that the yield curve is now inverting in what is seen as a risk off economic cycle. Right, so now we're getting an inversion into a risk off economic cycle. Well, that's just more weight to the risk off regime.
Yeah, it's just another statistic that
it's another data point
contributes to the risk off play.
Right, and it's a very powerful data point. It should be weighed more than something like let's call it employment, right? Well, the yield curve is also pricing in employment and what the Fed's going to do. The yield curve, like our system, is pricing everything real time, which is why you need to use the twos and tens, because the 3-month 10-year curve or spread can't price everything in real time because it's locked for the next 3 months by what the Fed's going to do. We're more rate hikes are coming in post the maturity of that.
So if the Fed comes out to be more aggressive with their rate hikes and really front loads the rate hikes, that's what would bring the 3-month to invert with the 10-year.
Not necessarily. That's a good point. No, not necessarily. So where is it here? Here it is. Realistically, just time will invert this curve. That spread. That spread will just invert with time. Because as we go along, that spread will, think about that 3-month yield, it's going to shift higher, right?
Yep.
So over time, that spread will just end up, that spread will just end up inverting, right? Okay, so that spread itself is, unless we see a gradual pickup in long-term rates, where it basically can push the spread in the opposite direction, the 3-month, 10-year spread is just, it's pending an inversion.
Okay. Yeah, that makes sense. So it's kind of like an inevitable thing that'll happen.
Right. Now, let's just say let's go to your point where the Fed front loads rate hikes. Right? If the Fed front loads rate hikes right now, what they're going to do is they're going to just invert this curve even more.
Yeah.
If the Fed just keeps adding rate hikes, right, the 2-year, which we know encompasses all this, the terminals keep grinding higher. Every time the terminal, like on Friday, the terminals grind 20 basis points higher. This thing fell 14 basis points. I'm not saying it's symmetrical, right? But obviously terminals go up. From where we are right now, this yield curve is going to continue to, or these spreads within the curve, and the curve itself, matter of fact, is going to just invert more and more. So it's very important to watch the terminals. This is why we built a forecasting tool for everyone to see real time what's going on, because this is so important. The terminals move It affects the yield curve. It affects the way the market's pricing in risk. It affects even the system. The system is not specifically built on the yield curve, but the system does encompass the market, which does encompass the yield curve. So if the yield curve moves, the system's likely going to move, which, as you're seeing, the system is still staying risk off while terminals continue to grind higher. Now, could we get that explosion in growth that kind of saves us? Yeah, but as of right now, it's still unlikely. Everything in markets and in life is a probability. So we have to look at everything from a statistical viewpoint of happening, right? So what is the chance of this happening? Well, it's telling us the chance of risk on happening right now is under 40%. So we're not going to allocate capital or even talk about risk on until we get a definitive a majority of concentration in that category.
Yeah. And I think we could leave it off at that.
Yeah, I think that's a good place to cover it up, or to close this one out. And we will come back next week with a CPI report, which is going to be real interesting. So you're going to see some updates from us. Maybe we see the forwards curve shift a bit more to the upside, maybe to the downside. We'll see. We'll see if we can get some more rate hikes priced in, depending on the aggressiveness of the CPI report. All in all, though, I don't think the CPI report's going to do much in terms of changing the actual system. The system's not going to change on a dime like that in a day, because the system's a longer term thinking mechanism. So we're going to need to see how things progress realistically over time. But it's always good to see how data points are shifting up in the forefront, especially with the federal funds rate forward curve. And I think that's where we're going to leave off today. If you have any questions, feel free to go to our website at www.market-radar.com. We have all these models there for free. Anyone can sign up and use them and see what's going on. We have a free Discord there as well. The link's on the website, and our Twitter, where we tweet all market relevant events almost pretty much every day. You can see us there or ask us questions there at the Market Radar. And that is it. See you guys next week.